You look back to the Great Depression and you look at some of the stimulus that was put into play in the Great New Deal, for example, and then you account for inflation and look at what those numbers would be today, and this stimulus that we're seeing now is multiples of that. So it's unmistakably great for liquidity in markets to see the size and the force of governments around the world recognizing the economic shock we're going through. So I'm very happy about that, and that means the economic fallout will be mitigated to some extent. But make no mistake, if you think this is going to be a V bottom and we're through it, in the worst economic shock the world has ever felt since the Great Depression and the Great Wars, you're wholly naive. So we're getting what we call in the trading lingo a face-ripping rally here. But in all likelihood, this is a rally to lighten up in. And what you didn't get to sell because it happened so fast, now you find the names where you'll buy them back at some point, but you want to be selling into this. And we're getting more defensive on the rally. We were adding on the weakness only a few days ago, and now we're lightening up again and adding back hedges.
You are a deficit hawk. What about that side of this stimulus package? You say you are very much in favor of the stimulus. What about what comes next, years down the road?
Well, the amount of debt. I've said for a long time that there's no fiscal austerity is not going to ever be politically palatable, and we can see that with the ammunition. And they're never, ever, if I can be clear on that, going to be able to pay back the debt because the demographics and the growth patterns of the world just simply won't allow it. We are into a phase where central banks' balance sheets are going to be expanding. They're going to be literally printing money to offset the need for more debt in the world. And if that isn't the most bullish thing for gold, bullion, and silver perhaps, then I don't know what is. So there are going to be interest rates are going to have to stay extremely low. Listen, we're going to have to take down $2 trillion in debt in the next couple of months. And so fixed income markets are going to remain incredibly volatile. In part, a lot of the stimulus is going into smoothing that process out as much as possible. So, Paul, to reiterate again, if you think this is over, it's very naive.